Financial analyst is a deceptively simple label. It acts as a single professional umbrella for two career paths that rarely intersect in practice. The general public often assumes the role is synonymous with the stock market, a world of trading floors, ticker tapes, and high-volume Wall Street deals. In reality, the day-to-day work of an analyst is defined by the specific economic engine of their employer. This creates a divide in the industry between capital allocators on one side and operational optimizers on the other. Because these roles serve different masters, entering the field requires a clear understanding of which side of this divide a specific job actually sits on. This structural map defines two paradigms. Investment firms act as external evaluators, viewing businesses as assets priced for their potential return. Traditional companies sit opposite. They are operational entities, using analysis to tune internal efficiency and long-term profitability. While these paths share a title, they diverge significantly in their daily objectives and the stakeholders they report to. Each path relies on a different data pipeline and a unique analytical perspective to reach its goals. To understand how these two worlds function, we need to deconstruct their technical workflows side by side. The buy-side landscape is populated by asset managers, private equity firms, and hedge funds. Here, the analyst's primary mandate is the search for investment opportunities, identifying assets that can generate superior returns on capital. This role is defined by an external perspective. The analyst is a judge of value rather than a participant in the business. They are rarely involved in the specific operational decisions of the companies they are analyzing. Instead, they rely on a data ecosystem of public financial statements and broad industry research to form their conclusions. The ultimate goal of the buy-side analyst is to determine a precise price for a company's future potential. Consider an analyst evaluating SolarTech, a company in the renewable energy sector. The evaluation begins by filtering public data through specific financial lenses. The analyst assesses SolarTech's profitability and growth trends, building preliminary valuations using comparable company multiples and discounted cash flow models to estimate the present value of future earnings. This analysis is distilled into an investment committee memo, where the analyst must defend the company's potential in a boardroom presentation. If the board approves the project, the process moves into a more intensive phase. This due diligence phase grants the analyst temporary access to private management data, allowing them to refine their theoretical models with exact internal figures. The entire workflow is designed to build a rigorous mathematical case that justifies the risk of deploying capital today. Outside of the investment world, most analysts work within the real economy, where companies sell physical products and services. These organizations rely heavily on internal financial planning and analysis, or FP&A, to maintain their operational profitability and survive in the long term. We can see this in practice at a manufacturing firm like TechEquip. At a mid-sized company with 200 employees, a single analyst often has a 360-degree view of the entire financial operation. In a global corporation, that same analyst would likely be siloed, focusing on the efficiency of one specific region or product category. Their mandate is to track revenue development and monitor costs on a high-frequency, ongoing basis. While the external evaluator looks at the machine as a whole, the corporate analyst is embedded within it, ensuring every gear turns efficiently. This analyst works with a proprietary data ecosystem. They extract raw figures from enterprise resource planning, or ERP systems, which track every transaction in the company. In Excel, they perform variance analysis, measuring the gap between actual monthly performance and the original budget. This allows them to visualize profitability at the EBITDA level, segmented by specific clients, products, and locations. To explain these numbers, the analyst must communicate with sales and marketing teams to uncover the operational causes behind the shifts in revenue. As the year ends, the role shifts from reporting on the past to predicting the future. They collaborate with financial controllers to build the next year's budget and forecast the firm's upcoming financial needs. The value of the corporate analyst lies in their ability to turn disparate internal data into a clear strategy for executive leadership. By placing these roles side by side, the dichotomy becomes clear. The buy-side analyst evaluates the future potential of a business engine from the outside. The corporate analyst tunes the actual performance of that engine from the inside. Despite these differences, both roles are built on the same core requirement: the ability to translate complex data into a basis for executive action. The specific dialect of finance an analyst speaks depends entirely on which seat they occupy at the decision-making table. Recognizing this divergence is the first step towards effectively building a finance team or navigating a career in the field. Success in the role requires identifying whether your strengths lie in macro-level capital allocation or micro-level operational execution. Understanding the world of finance is ultimately about knowing which machine you are building and which machine you are buying.